Charting and the continuity of price. Trading by price requires a perceptual and conceptual readjustment that many people just cannot make, and many of those who can make it don't want to. Making that adjustment is somewhat like parting a veil, in that doing so enables one to look at the market in a very different way, one may say on a different level. One must first accept the continuous nature of the market, the continuity of price, of transactions, of the trading activity that results in those transactions. The market exists independently of you and of whatever you're using to impose a conceptual structure. It exists independently of your charts, your thoughts, and your feelings. It could not care less if you use candles or bars, plot this line or that, or select the daily bar interval, weekly bar interval, monthly, 1 minute, 5 minute, 10 minute, or even use charts at all. Therefore, trading by price, or at least doing it well, requires getting past all that and perceiving movement and the balance between buying pressure and selling pressure, independently of the medium you used to reveal that activity. Trading is not, here's a trade from this morning, or here's a trade from yesterday, or even here's a trade from a minute ago. Trading is, it's 9:46, what do I do at 9:47? Or, price is at 26.25, what do I do if it hits 26.50? All you have when you're ready to begin is what came before. One hopes that you know where support and resistance lie. Maybe you have a trend line that looks dependable. The uppermost question in your mind should be A, what now? And B, what do I plan to do about it? Coulda, woulda, shoulda has its place, but the step into trading, the right edge of the chart, is a high and often insurmountable one. Trading should be like going to a game where you know nothing about either of the teams and could not care less who scores, much less wins. Having a trade on makes this more difficult, but the principle remains. To do otherwise implies trading with ego, and that state clouds perception and judgment. Remember first and foremost that it is all about buyers and sellers, not about lines and bars. However one chooses to illustrate the activity serves only to clarify what buyers and sellers are doing. Each trading session is a story. The professionals have not only read the prologue, they've memorized it, though they will not all look forward to the coming session in the same way. The amateurs will not even know what they are playing in. When the bell rings, buyers will have one thing in mind, sellers will have another. If you view the activity as an ongoing and continuous drama, you may be able to better understand what the other players are trying to do and avoid getting caught up in the minute details. The market, in other words, will tell you what to do if you understand its language and if you will just listen. Most traders, however, have so much going on in their heads that they cannot hear, much less listen. Sometimes it's saying, I ain't going nowhere, just chill out. Begin by thinking of the market as a giant bazaar. Lots of buyers and sellers, all excitedly negotiating prices, working to make a deal. If a lot of people are crowded around a particular merchant's stall, they can demand premiums for their goods. If another merchant is getting little or no traffic, they must lower their prices in order to unload their stock. If they are able to manufacture a demand, they can then raise their prices again. Either that or use whatever demand they create to unload whatever crap they're selling and move on to something else. Consider also that all stocks go through accumulation and distribution cycles. These cycles can last for anywhere from a few minutes to several years. Which cycle you focus on will depend on what kind of investor you are and what your time horizon is. Here's how it works. Somebody's attention is caught by a particular company or its stock. They like it, think the price is reasonable, and begin accumulating it. They do it gradually and in small lots, so they do not attract attention for what they're doing. If they attracted attention, others would start buying the stock as well, and the price would be driven up because of the increased demand. When they have accumulated all they want, they will either hold on and wait, or they will test the market by offering some of their shares to see what the demand is. If the demand is there, they will offer more as the price rises. If the demand increases and the price rises further, they may hold back their shares and let other holders provide the supply for the time being, then sell more of their shares or all of them when the price represents their targeted profit level. Selling into this increased demand is distribution. It, like accumulation, is quiet. The holder of the shares doesn't want to dump a huge amount of supply onto the market for fear that there may not be enough demand to absorb it. And the last thing he wants to do at this point is drive the price down. When the stock is topped out and real selling takes place, he is already out of the stock. Therefore, unless demand increases further, the stock falls until it represents value. Value to somebody for some reason. Then the whole process starts all over again. This is the basic process and cycle. However, it's complicated by the fact that there are many buyers and sellers, each with his own agenda. A seller may distribute all of his stock, for example, but demand continues. It may not be enough to drive the price higher, but it will be enough to keep the price from falling. So you enter a secondary, maybe a base, in which new accumulation distribution cycles begin. The trick is to figure out whether this new consolidation period represents accumulation or distribution. How does the stock react when a lot of stock is dumped onto the market? Does it tank, or does it decline only by a trivial amount? Is there follow-through to this action, or are the following days business as usual? If it is a short, sharp decline with no follow-through, you're probably looking at a shakeout, basically forcing weak hands to sell their shares so the stronger hands can pick them up at a discount. Or a spree of short selling, but the latter is unlikely since it usually takes place over time. It's important to remember that for a transaction to take place, there must be a buyer and a seller. Huge volume and an increase in price indicates a lot of buying, but it also represents an equal amount of selling. Volume, in other words, reflects only the number of shares traded. Whether the pressure is on the demand side or the supply side is reflected in whatever happens to the price. Unless you put this activity in a context of markets, market psychology, demand and supply, you stand a good chance of misinterpreting what is happening. A chart, then, is nothing more than a visual representation of transactions. The result of these transactions are depicted by either a line or a bar, which represents the opening price, the little notch on the left side of the bar, the low for the day, the bottom of the bar, the high of the day, the top of the bar, and the closing price, the little notch to the right of the bar. Beyond all this, a chart is a visual representation of buying and selling behavior on the part of investors, not just a tally, and this behavior creates behavioral patterns. These behavioral patterns do not exist in nature. They are created by buying and selling dynamics. The goal, then, is to be able to judge the market by its own actions within the framework of these patterns to gain a consistent, profitable edge over the markets. Judging the market. Chart reading enables one to detect and profit by judging the future course of stocks by weighing the relationship of supply and demand. By accurately judging this supply and demand, you are able to determine the trend of the whole market and of certain stocks, also which stocks to buy or sell, and what is even more important, when to do so. You always aim to select the most promising opportunities, that is, the stocks which are actually likely to move soonest, fastest, and furthest. You make no commitments without sound reasons, and you avoid undue risks. Whenever you study a chart, consider what you see there as an expression of the forces that lift and depress prices. Study your charts not with an eye to comparing the shapes of the patterns, but from the viewpoint of the behavior of the stock, the motives of those who are dominant in it, and the successes and failures of the buyers and sellers as they struggle for mastery on every move. The struggle is continuous. The chart shows all this in detail. The chart enables you to pick the market apart and study whatever portion or phase of it you choose. A chart is like a motion picture film. Every minute of the day, it is demonstrating whether supply or demand is greater. Prices are constantly showing strength or weakness, strength when buyers predominant, and weakness when the offerings overpower the buyers. All the various phases, from dullness to activity, from strength to weakness, from depression to boom, and from the top of the market down to the bottom, all these are faithfully recorded on the chart. All these movements, small or great, demonstrate the workings of the law of supply and demand. You draw from your charts the comparatively few facts which you require for your purpose. These facts are the speed of price movement, the duration of that movement, the extent of that movement, and the relationship between those three. Supply and demand. The law of supply and demand operates in all markets in every part of the world. When demand exceeds supply, prices rise, and when supply is greater than demand, prices decline. This is true not only of stocks, it is constantly being demonstrated in markets for wheat, corn, cotton, sugar, and every other commodity that is bought and sold. Also, it's reflected in other markets such as real estate, labor, etc. The stock market, by its own action, continually indicates the probable direction of its immediate and future trend, and anyone able to determine this with accuracy should attain success in trading and investing. The trend is simply the line of least resistance. When a stock meets opposition in its rise, it must either be strong enough to overcome this resistance, or selling, or it must inevitably turn downward, and when, in its downward course, sufficient buying is encountered to halt the decline, it will turn upward. The critical moments in all these various phases of the market are these minor and major turning points, or else the points where the price breaks. There is only one essential, one linchpin, one fundament when it comes to understanding the auction market: supply and demand. Everything else, support and resistance, trend, price movement, and volume, stems from the balances and imbalances between supply and demand, selling pressure and buying pressure, sellers and buyers. Struggling traders are generally incapable of accurately assessing the state of these imbalances, i.e., determining who's in charge at any given moment or interval. Some are capable, but cannot implement what they know, but that's another subject. Trading price and judging supply and demand hinges on the ability to assess the state of these imbalances, not only in the abstract, but in every moment of the trading session. If traders do not thoroughly understand just what they are looking at, they will be lost. When trading price via supply and demand, traders know at all times who's in charge, who's dominant, who's holding the good cards. If they do not know this, they are just guessing, and that is not the route to consistent profits. Now, why bother? Because once you learn how to trade price, your edge will never fail. You will understand trend and how to play it under all circumstances, including its ends and reversals. You will also learn how to distinguish between trending and ranging, the latter including chop, which is also a collection of micro trends which generates tons of commissions and very little, if any, profit. Now, let's talk about market waves. Every upward or downward swing in the market, whether it amounts to many points, only a few points, or fractions of a point, consists of numerous buying and selling waves. These have a certain duration. They run just so long as they can attract a following. When this following is exhausted for the time being, the wave comes to an end, and a contrary wave sets in. The latter may attract more of a following than the former. By studying the relationships between these upward and downward waves, their duration, speed, extent, and comparing them with each other, we are able to judge the relative strength of the bulls and the bears as the price movement progresses. The market does not rise and fall like water in a tank, which is being filled or empty. It moves to a higher or lower level by a series of surges, like an incoming or outgoing tide, with successive waves higher or lower than those preceding. The small buying and selling waves, which occur during every stock market session, run so many minutes. They are caused by largely the restlessness of active professional traders, much like the ripples produced by the wind upon the ocean. Traders must have activity. They make their livelihood by trading on fluctuations. Therefore, they engage in a ceaseless tug of war, trying to put up prices whenever the condition of the market is favorable, or drive them down when they find that the bulls are weak or have overextended themselves. The degree of success or failure attending their efforts enables us to determine whether the market is growing stronger or weaker. These small waves are part of the larger waves, which run several days, weeks, or even months. You can easily confirm the above by examining any chart. It is important that you do this so as to impose upon your mind these numerous waves of various sizes, inasmuch as this will help you understand the market. You will thereafter think in waves. The waves of the market furnish a clear insight into the changes of supply and demand. By learning to judge all sizes of market waves, you will gradually learn to spot the time when a rising market or the time when a declining market or reaction has halted and is about to reverse. These are the turning points. To be able to say when these turning points are occurring at the bottom of a bear market or at any important rallying point on the way down to the bottom, or at the top of a bull market, or at any important reactionary point on the way up, is a mark of ability in an investor as well as a trader. Remember, the market itself tells us everything we need to know about its probable future action. Every significant change in supply or demand is registered on the chart. When you have learned to analyze the market by its own action, as recorded on your charts, then you will be proficient in the art of operating in stocks. The chart here is comprised of several bars. Each bar represents one full day of trading. As stated above, we must remember that each bar is comprised of many buying and selling waves, and each bar comprised of hundreds or thousands of transactions. To attach any particular meaning to any one particular bar, then, is misdirected unless one is clearly in mind all that was done during the day to create the bar in the first place. Move away from bars then, and begin to look at the underlying sentiment which propels the formation of these bars. Look at the movements as a whole, and hopefully you will be able to see the duration, extents, angles, or strides of these waves as a whole. Sometimes, to drive this principle home, it's easier to view the chart as just a line. Viewing price in this manner, one might more readily be able to see the ebb and flow of buying and selling waves without solely focusing on bars. Here's another chart for comparative purposes. Just looking at this might not provide a revelation, but sometimes comparing a line chart to a bar chart can help you to get back in sync with the underlying movement of the market if one finds themselves getting too entangled with the trees that the bars can represent and the alleged meaning that they may have. Once a trader feels they grasp the idea behind the continuous line and the continuous waves, they can always put the bars back. Here's a bar chart with a line overlay connecting the high and low points of these waves. Looking above, one can compare the extent, duration, and angular ascent, descent, or the stride of these waves. Do the buying waves, the black lines, last longer and go further than the selling waves, or the red lines? Are the selling waves beginning to last longer and go further? Where do these waves appear to stop and start? Participants have demonstrated this kind of thinking in their analysis of price movement as it wends its way up and down through a continuing series of peaks and troughs. These waves are a language, narrating the behavior of buyers and sellers. Whether participants' every opinion has been correct or not, they have worked toward understanding the story that is being told by price movement and toward gauging and interpreting the continuous changes in buying and selling pressures with the intent of finding the line of least resistance. If the buying waves are longer in duration and travel further than the selling waves, we get an indication that the immediate trend is upward. If the selling waves exceed the buying waves in time and distance, the immediate trend is downward. Whenever the buying and selling waves seem to offset each other and no material strength or weakness is indicated, the immediate trend is in doubt. Our position should be neutral. Each individual wave has a certain anatomy. It's comprised of a high point, a low point, and a midpoint or halfway point. This is often referred to as the 50% level. These individual points act as reference points which help to determine trends and to compare strength versus weakness in the market. There is an advantage more specifically to be gained by watching halfway points on rallies and reactions as a basis for judging strength or weakness. When a stock advances by 4 points and then reacts by 2 points, it may be called a normal reaction. If the market reacts less than 2 points, that gives us an indication of strength. Now, if the market reacts by 3 points, that would give us an indication of weakness entering the market. These midpoints, halfway points, or 50% levels act as a measuring stick for the comparative forces of buying and selling. Using high and low points, we can ascertain strength or weakness as well. If a stock declines by 3 points and then rises to recover all of those 3 points, that would be considered a sign of strength. This is a sign of strength versus weakness because the sellers, having spent their forces, are met and overcome by buyers, who at the moment of completion of the recovery are in a comparatively stronger position. The buyers have taken everything the sellers have had to offer on the way down and took whatever stood in their way on the way back up. Here is a chart now to help illustrate these points. At point 1, we have a high point of our initial buying wave on the chart. Letter A represents the midpoint of that up wave. As we continue to the right, price begins to move lower, approaching 50% of the up wave marked by letter A. This point, letter A, is our measuring stick for strength and weakness. At point 2, we can see that price has halted its decline above the halfway point of the initial up wave, which indicates a sign of strength and potentially a continued move to the upside. Letter B represents the halfway point of the down wave. As price continues its rise and passes through letter B, this gives us a momentary confirmation that price is strong due to the fact that we now have recovered more than halfway of the previous down wave. At point 3, we now have a situation, again, of continued strength because price has now made a higher high breaching point 1. However, we can see that at point 3, the extent of the up wave from point 2 to point 3 is shorter than that of the first up wave. This is a warning sign that some weakness might be coming in. Letter C represents the halfway point of the up wave from point 2 to point 3. At point 4, after price passes through letter C, we now have a situation where the market is weakening more than we would like it to if we were in a long position. Although the market does indicate some minor weakness at that moment, passing through letter D gives us a bit of renewed strength because we are passing through the midpoint of the down wave from point 3 to point 4. Point 5 is where things get interesting in our analysis. The down wave from point 3 to point 4 represented our first indication that we might see some continued weakness or at least a greater diminishing of strength. There are 2 reasons for this. One is the fact that we did breach letter C, which is 50% of the previous up wave, point 2 to point 3, and secondly, the down wave from point 3 to point 4 is longer in extent and took less time to move that length than the previous down wave from point 1 to point 2. At point 5, we then see that the up wave, point 4 to point 5, cannot make it all the way back up to point 3. It, in essence, is too weak to do so. This up wave leading to point 5 is also much shorter in extent than our first and second up waves. Coupling this with the fact that price was unable to make its way back to at least point 3 is a very good indication that the market will become weaker. Price then, moving down to point 6, confirms our opinion that the market might become weaker. The weakness here is shown first by breaching letter F, the halfway point between point 4 and point 5. Secondly, by breaching our last swing low point at point 4. Finally, at point 6, we can see that from point 3 to point 6, we now have a movement that equals that of point 2 to point 3. Retracing that whole prior up wave indicates weakness. Since we now have equal movement up versus equal movement down, the prior uptrend is certainly in doubt and we should maintain a more neutral opinion. Point 7 represents a point where one can say that the market is still weakening or at least still neutral. Strength can be seen due to the breaching of letter F, the downwave halfway point. However, at point 7, price fails to make a new high. Price fails to trade past both point 5 and point 3, showing that said weakness. While this upwave, point 6 to point 7, is greater in extent than the upwave moving from point 4 to point 5, it's shorter than the previous two upwaves that finished at point 1 and point 3. Due to this analysis, one might anticipate a move back towards letter G, the halfway point of the latest upwave. Point 8 confirms our opinion that we were more likely to see continued weakness. We retreated back towards and through the prior midpoint at letter G, which was anticipated. Price then moves back through both swing low points located at point 2 and point 6. All of these signs would suggest a continued move lower. Moving from point 8, price must clear letter H before one could assert that the market has regained strength. Thinking in terms of waves allows us the ability to better track the movement of price. It allows us to see who has the upper hand, buyers versus sellers. Finally, it allows us to build structure in our trading as well as locate future potential trading opportunities. Let's talk now about how we can track the stride of these waves with lines. The stride of an upward movement is reflected in the angular upward climb of the daily vertical bars on our charts, and the pace of a downward movement by their angular downward pitch. The eye may not always see the pitch of these angular swings clearly because of the confusion effect of minor irregularities of the price movement as recorded on charts. Therefore, it is frequently helpful to employ specific drawn lines for this purpose. Looking at a chart on which no lines of any sort have been drawn is sort of like the robbery movies where the guy is trying to steal the big diamond that is sitting on a big pedestal in the middle of the room. He knows that there's an alarm which is triggered by the interruption of one or more of a series of laser beams which crisscross the room. Unfortunately, he does not know where those laser beams are because they are invisible to the naked eye. So what does he do? He blows smoke into the room so that the beams become visible. Knowing where they are enables him to miss them and avoid setting off the alarm. Similarly, there are a variety of lines on your chart even though you may not be able to see them. Now, blowing smoke on your chart will be of no help. However, so you will have to be satisfied with a less dramatic straight edge and pencil, or the line tool on your trading platform. The purpose of drawing lines is to help traders find order in all of these price points and tell him whether it's going up or down. Drawing lines will also help them find the best entry and exit points by supplying additional information about support and resistance. In practice, these lines are used to alert traders to potential changes in the character of the trend and even reversals of that trend, and that's a big job for one tool. Drawing lines on a chart can be an opportunity for some real creativity. The more creative you are, the less helpful your lines will be. If your lines do not actually indicate the trend of the stock, if they do not point toward potential support or resistance to the price, if they are not of genuine help to you when you are trying to decide whether to buy or sell or not, then you have drawn the wrong lines, or you've drawn the right lines but in the wrong places. Doing so is not unusual because we have a natural impulse to bring order out of chaos, and we will try anything to force the chart to divulge its secrets. To reduce this creativity in the framework of our trading system, there are 3 different types of lines that we can draw on our charts. These lines will help us create trading waves, track the stride of these waves, and build structure among these waves. The 3 types of lines are tape lines, wave lines, or supply and demand lines, and trend lines. The tape lines track the shortest term changes in price movement. The wave lines, or supply and demand lines, track the initial change in the intermediate buying or selling interest, or the waves of buying and selling. The trend lines track the overall direction of the combination of multiple trading waves tracked by supply and demand lines, or wave lines. Okay, let's break into our first set of lines, the tape lines. The tape lines are based around 6 specific 2-period bar patterns. The periods being days, minutes, weeks, months, 5 minutes, doesn't matter, they're all the same. The patterns are channels, triangles, inside bars, outside bars, double breaks, and boxes. Upward sloping lines track the shortest term buying interest, and downward sloping lines track the shortest term selling interest. Each tape line has an upper and lower line associated with it. These lines provide a visual representation of where potential price reactions might take place. They are used as inflection points for the shortest term movements in price. For the purpose of this discussion, we're going to use the daily time frame as our interval of choice. Whether one chooses to use a 1-minute chart, 5-minute chart, a combination of both, it's irrelevant. The same patterns exist on all time frames. So with that said, the first tape lines to be discussed are the tape channel lines. There are both up channels and down channels. Up channels are defined as today's high being higher than yesterday's high, and today's low being higher than yesterday's low. If you were to use a 1 minute, it would be this current minute's high is higher than the prior minute's high, and the current minute's low is higher than the prior minute's low. The down channels are the opposite. Down channels would be defined as today's low being lower than yesterday's low, and today's high being lower than yesterday's high. The figures here show these channels. The up channel tape line attaches the 2 low points between the 2 bars as seen in figure 1. In attaching this line, the higher low point of the second bar can be seen. The up channel line is copied and attached to the high point of the bar at the point where the overbought line, the upper line, will not be cutting through any of the 2 bars. Attaching the overbought line to the first bar allows the line to not cut through the second bar in the up channel tape. The pattern here is a higher high and a higher low. The down channel tape line attaches the 2 high points between the 2 bars as seen in figure 2. In drawing this line, the lower high point of the second bar can be seen. The down channel line is copied and attached to the low point of the day where the oversold line, the lower line, will not be cutting through any of the 2 bars. In this case, the oversold line is attached to the second bar in this example. If the oversold line was attached to the first bar, it would have cut through the second bar, which would be incorrect drawing. The pattern here is a lower low and a lower high. Our next patterns to be discussed are triangles. The 2 triangle tapes are ascending triangles and descending triangles. Ascending triangles are defined as today's high being equal to yesterday's high and today's low being higher than yesterday's low. Descending triangles are defined as today's low being equal to yesterday's low and today's high being lower than yesterday's high. The ascending triangle, figure 3, is drawn slightly different than channels. The tape line connects the 2 low points showing the higher low point, similar to the up channel, the lower line. This line slopes upward. The difference is the next line, the upper line, connects 2 high points, and in this case, the high points are equal. This formation takes the shape of an upward sloping triangle. In the descending triangle, figure 4, the tape line connects the 2 high points showing the lower high point. This line slopes downward. Here, the next line, the lower line, connects the 2 low points which are equal. This formation takes the shape of a downward sloping triangle. The next pattern is the inside bar. As the name suggests, the current day's bar in this tape is within the range of the prior day's bar. This bar is defined by today's high being lower than yesterday's high and today's low being higher than yesterday's low. This puts the range of the current day inside the range of the prior day. Again, interval doesn't matter. If it's 1 minute, then the current 1 minute range would be inside the prior 1 minute range. In the inside bar, figure 5, the lines are drawn connecting the lower high points and the higher low points. There's no such thing as an up or down inside bar, since the high and or low of the inside bar does not break the prior bar's high and or prior bar's low. The next tape is the outside bar. This pattern is essentially the opposite of the inside bar. The outside bar consists of the current day's range being outside of the prior day's range. This bar is defined by today's high being higher than yesterday's high, and today's low being lower than yesterday's low. This puts the range of the current day outside of the range of the prior day. In the outside bar, figure 6, the lines are drawn connecting the higher high points and the lower low points. Next on the list are the double break patterns. The two patterns here are the double bottom breakout and the double top breakdown. The double bottom breakout is defined by today's low being equal to yesterday's low and today's high being higher than yesterday's high. The double top breakdown is defined by today's high being equal to yesterday's high and today's low being lower than yesterday's low. In the double bottom breakout, figure 7, the tape line attaches the two high points together, showing the higher high which broke the prior day's high. The lower line attaches the two low points, those being equal, or the double bottom. The double bottom breakout is considered an up bar pattern because the high of the current day is greater than that of the prior day, with the two low points being equal. In the double top breakdown, figure 8, the tape line attaches the two low points together, showing the lower low which broke the prior day's low. The upper line attaches the two high points, those being equal, hence the double top. The double top breakdown is considered a down bar pattern because the low of the current bar is less than that of the prior bar, with the high points being equal. The final bar pattern is the box. This bar pattern is defined by today's high being equal to yesterday's high and today's low being equal to yesterday's low. The range of the current day is equal to that of the prior day. In the box pattern, figure 9, the tape lines are drawn attaching the equal high points, the upper line, and the equal low points, the lower line. The formation here takes the shape of a box. Let's now take a look at how we can track the flow of price with the first level of lines being the tape lines. This examination will go through a series of charts providing insight on how to continuously track price as it moves from day to day, minute to minute, whatever interval you choose. In the examples to follow, red lines will be used for down movements and black lines will be used for up movements. Each 2-day sequence creates a pattern, so bar 1 and bar 2 create the first pattern, bar 2 and bar 3 create a new pattern, bar 3 and bar 4 a new pattern, and so on. The series of charts here show the beginnings of price movement. In figure 1, we have our typical down channel tape with its associated lines drawn. As stated before, we attach the two high points with a down tape line and then create a duplicate and attach it to the low point where the lower line will not cut through any of the bars. In this case, the second bar with the line located at point 2. Next, in figure 2, we can see darker red lines drawn and a new down channel is created. We call this down channel acceleration because the slope of the channel has moved further to the downside. This shows an increasing pace to the downside. In the chart labeled figure 3, the fourth bar on the chart, although it has accelerated to the downside, it's within our first down channel that was originally drawn in figure 1. In this case, the two lines that were drawn from figure 1 are our main focus and the accelerated lines can be deleted. Bar 5 on this chart represents the completion of a box tape, figure 4. The bar labeled with point 1 and point 2 is the first bar of the sequence, and point 3 and point 4 the second bar. The highs and lows are equal here, hence the box pattern. Price has now moved from a down channel tape into a box tape. At point 3 on this chart, we can also see a shift in the patterns because point 3 has broken through the down tape line, the upper line, that was drawn marking the down channel. Moving along in figure 5, we now have moved from the down channel to the box and now to an up channel tape, labeled with the black lines and the black points 1, 2, 3. Again, we have the up channel line drawn connecting the low points showing the higher low, points 1 and 3, and the upper line, which is copied from the lower line and then placed at a point where the line does not cut through any of the bars in the 2-bar pattern. That's point 2. If the upper line is placed on the bar with the black point 1, the upper line would cut through the second bar in the pattern and be incorrect. In figure 6 at point 2, we've broken through the up channel tape line, the black line from prior, and Price created a lower high point, point 3, and a lower low point, point 2. This now creates a new down channel tape. In figure 7, we have our first inside bar labeled with point 1. The high and low point are both inside the high and low of the prior bar. We see this by drawing the two thinner red lines which attach the high and low points. This inside bar is showing a bit of deceleration from the darker red lines, which is the down channel, drawn prior. Deceleration is a slowing of the pace of price movement opposite that of acceleration, which is the increasing pace of price movement. In figure 8, we have another down channel tape which breaks out of the inside bar pattern. This time, it was drawn with blue lines just for illustrative purposes to reduce confusion. This down channel pattern also continues the prior deceleration initially created by the inside bar. This is drawn by the upward shifting lines attaching points A and B. This can be further illustrated in figure 9, where we can then connect the two down channel tapes. This is shown with the darker red lines and labeled with points 1, 2, 3. Here, the dark lines are tilted up versus the downward sloping thinner lines of the initial down channel. Since we can connect the two down channel tapes, the darker lines now become our main focus. Figure 10 represents a new up channel pattern. This up channel breaks through the previous down channel, indicating a potential change from down to up. In this channel, as opposed to the prior up channel from earlier, the upper line is attached to the high of the first bar in the pattern versus the second. This is a good example on showing the difference between attaching the lines. If the upper line was attached to the high point of the second bar in the channel, the upper line would cut through the first bar of the channel and would be incorrect. Figures 11 and 12 depict a period of deceleration and how we would draw it out. Figure 11, we see the angle of the second up channel in this sequence to be sloping lower than the first. This represents a slowing of the upward moving pace of price. In figure 12, because we now have two up channels in the sequence, we can attach them together. When we attach the two up channels together, we draw it in the same manner we would any other channel tape. The darker black line in figure 12 attaches points 1 and 3, which are the lowest low and highest low of the channel. When we copy the up tape line to make our upper line, we position it at the high of the first bar in the upward moving sequence because the extended line from this point would not cut through any of the other bars. Similar to that of the previous sequence of charts, we can observe continued deceleration in figures 13 and 14. In figure 13, we have a new tape we have not yet seen in prior examples. This pattern is the double bottom breakout. Points 1, 2, 3, and 4 in figure 13 depict this tape. Points 1 and 3 are equal, and at point 4 we have moved higher, or broken out above point 2. Point 3 in figure 13 has broken down below the up channel tape line we have drawn, and the high point at point 4 was unable to move high enough to touch our upper line drawn in the up channel. The inability of price to make a high or low from point 1, and its inability to move high enough to touch the upper channel line defines this further deceleration. Figure 14 shows how a new decelerated up channel can be drawn combining all of these tapes. The darker, thicker black lines display this new up channel. We connect point 1, the lowest low, and point 3, the highest low, to create the up channel tape line, the lower line, and we copy that up tape line to create the upper line. We attach the upper line to point 2 for the same reasons as prior. At point 2, the new upper line, when extended, will not cut through any of the previous bars. Point 3 here is interesting because it is equal to the previous bar's low, so one could ask, if it's equal, how is it decelerating? The answer to this is time. As we move to the right, that being one whole day of trading in our examples, we can see that the stride has shifted further to the downside, creating this deceleration. As time moves on, so might the lines. Figures 15 and 16 illustrate how, at times, price can get comfortable moving within a specific channel. Price does not stay within the channel because the lines are drawn. They are not barriers or containers of price movement. The lines rather provide a guideline for us to follow along with price, allowing us to better describe and evaluate in detail what we are observing on our charts. Remember, price is telling us a story of the dynamic between buyers and sellers. In this example, price is telling us buyers are relatively in control and are comfortable just moseying on along, maintaining a specific stride. In figure 16, 3 different channels can be drawn. The sequence is an up channel, a down channel, and another up channel. All of these channels are occurring within the prior up channel, the dotted black line. None of these movements have shown any inclination of breaking through either of the channel boundaries, indicating the maintenance of the existing stride and the coasting nature which price can sometimes exhibit. The next 2 days in the sequence represent what are called tests. For a moment, some of the lines have been removed and others not drawn, just to eliminate some of the clutter that drawing every single line can create. First, price is still maintained within the up channel, the dotted black line, labeled 1, 2, 3. From letter A to letter B, price has traversed the entire channel in one day, testing both the up tape line and the upper line, finishing its movement at the upper line. At letter C, we have a second test of the upper line. However, the bar labeled C does not traverse back down to the up channel tape line drawn. This is an indication of strength and for there to be potential acceleration in the future. In figure 18, we clean up the chart and draw in the potential accelerated up channel where the 2 tests took place from figure 17. The increased angle of the lines shows this potential for an increase in pace to the upside. The final chart in our tape line sequence confirms our opinion that we might see an acceleration to the upside. At the bar labeled with point 2 and 3, price breaks through the upper line of the longer up channel drawn and now tests the upper line from the up channel tape drawn from figure 18. At point 3 in figure 19, we observe price does not test the up channel tape line, and because of this creates an increase in pace to the upside. We draw this channel as an accelerated up channel represented by points 1, 2, 3, the thicker black lines. So for the moment, this culminates the explanation of how to draw our first level of lines, the tape lines. A little bit of confusion at this point is understandable. Continue to review these rules and apply them to any and all of the current charts you are examining. The more you practice, the more the principles will sink in. Next, we move on to wave lines, which is our second level of lines in our system. A wave line within our system is comprised of 2 tape patterns, one up tape and one down tape, and is considered the second trading level in our trading environment. Each level in our system builds upon the last. A potential up wave then would consist of an up tape followed by a down tape, and a down wave would consist of a down tape followed by an up tape. When the high point of an up tape is broken after the prior down tape, the up wave is said to be confirmed. On the flip side, when the low point of a down tape is broken after the prior up tape, the down wave is said to be confirmed. These waves are tracked with lines, so therefore an up wave line or demand line tracks the immediate change of buying interest, and a down wave line or supply line tracks the immediate change in selling interest. Similar to the tape lines, the wave lines can be duplicated and placed at specific high or low points, creating channels. These channels can help reveal potential reaction points that we can observe when tracking price. When an up wave line is duplicated and placed at a high point, the duplicated line is called an overbought line. And when a down wave line is duplicated and placed at a low point, the duplicated line is called an oversold line. When price is tracked with wave lines, it should be noted that waves can only move in channels, unlike the tape patterns discussed earlier. Here are examples on how we can build waves from tapes. Figure 1 represents an up wave and Figure 2 a down wave. In Figure 1, within the thicker black lines, we have thinner lines drawn. The thinner lines represent the tapes. Looking within points 1, 2, and 3 in Figure 1, we can see an up tape, the thinner black lines within the channel, followed by a down tape, the thinner red lines within the channel. This defines our potential up wave. Once point 2 is broken by the following up channel tape, the up wave is confirmed. We draw the up wave line attaching point 1 and 3. We duplicate the line, creating the overbought line, and attach it to point 2. In a similar fashion to the tape lines, the duplicated line will be attached to a price point where the overbought line does not cut through any price bars within the wave. Figure 2 is the opposite of Figure 1, that being a down wave. Reiterating that we need 2 tapes to make a wave, first we see the thin red lines representing the down channel tape, followed by the thinner black lines representing the up channel tape. At this point, we have 2 tapes, a down channel tape and an up channel tape. This defines our potential for a down wave. The downward sloping line can be attached to point 1 and point 3, creating the down wave line or supply line, which is duplicated and attached to point 2. The duplicated line is the oversold line, and it is placed where it does not cut through any of the price bars, just like the overbought line in an up wave. When point 2 is broken by the next down channel tape, the down wave is said to be confirmed. Let's re-examine the tape level examples we went through earlier to show how the second level, the waves, are created. In Figure 3, starting from left to right, we have a down channel tape shown by the red points 1, 2, 3, followed by the box ending at the black point 1, and finishing with the up channel tape shown by the black points 1, 2, and 3. This situation represents a potential for a down wave to be created since we have the necessary 2 tapes, a down tape and an up tape. The potential down wave lines are drawn here in Figure 4, shown by points 1, 2, and 3, combining the 2 tapes. The thicker, darker lines are the wave lines, and the thinner, lighter lines are the tape lines. The down wave line is attached to the high point of the first down channel tape at point 1. The line is then attached to point 3, the high point of the up channel tape connecting the 2 tapes. The down wave line is copied and attached to point 2, the point where the oversold line would not cut through any of the previous bars. Figure 5 depicts the confirmed down wave. For the down wave to be confirmed, price must trade lower than the prior low point, which is labeled at letter A. A green line is drawn for illustrative purposes to show at letter B price traded lower than letter A, confirming the down wave. The down channel tape that confirms the wave is labeled with points 1, 2, and 3. In Figure 6, some of the tape lines have been eliminated just to clean up the image and show how price is still moving within the down wave points 1, 2, and 3. At letters A and B, we can observe that price is not weak enough to move towards the oversold line and in fact mildly breaches the down wave line. This can give us an indication that price might begin to head in the opposite direction. In Figure 7, there is a slight break of the down wave shown by the up channel tape labeled with the black points 1, 2, and 3. The tape level will always be the first level to break the stride of the opposing wave. For a potential up wave to be created, we would need to see a down tape opposing this now created up channel tape. In Figure 8, price took 4 days after the break of the down wave to give us a situation where we can create an up wave. Price moved within the decelerated up tape before the formation of the down channel tape labeled with the smaller red points 1, 2, and 3. At this point, we have potential for an up wave. Figure 9 shows the confirmed up wave. At letter A, the green line is broken to the upside by an up channel tape. The high of the prior up channel tape is broken, which by definition confirms the up wave. In this example, the up wave line attaches the low point of the up channel tape and the low point of the down channel tape. The overbought line is placed at that point because the upper line, or overbought line, will then not be cutting through any of the preceding price bars. While at the end of the example in Figure 9, momentary strength was shown, the total up wave is now decelerating. This essentially is exactly the same as the situation that was observed on the tape level of our system discussed earlier in the video. The original wave was drawn with the dotted black line, and the now decelerated up wave is drawn with the solid black lines and labeled with points 1, 2, 3. The downward shift of the lines shows this deceleration and is an indication of the slowing upward momentum of price at this point in time. As price moves back up towards the overbought line here in Figure 11, we see a situation where instead of price turning back down toward the upwave line, it breaks through the overbought line. When this occurs, it's called wave expansion. The up channel tape labeled with points 1, 2, and 3 depicts the breaking of the overbought line. Figure 12 shows how we can draw the up wave expansion. The up wave line, letter B, is copied and is now attached at letter C, which is the new high for the current up wave. Letter A is the day of the wave expansion. The wave expansion represents an increase in volatility within the wave to the upside. The stride of price then can be said to be gaining momentum to the upside. In Figure 13, we have the same situation as Figure 12. Here we have continued wave expansion, continuing the increase in momentum to the upside. Again, the up wave line at letter B can be duplicated and now placed at the new up wave high at letter C. Letter A shows where price broke through the new expanded overbought line. Price is showing strength when this type of action occurs. Often, when a wave expands too far and too frequently, it will then need a moment to rest. Figure 14 shows this momentary resting place. Letter A shows a tape pattern called the inside bar. Neither a high point or low point from the previous day was broken, which indicates price is taking a breather. At this point, price could either continue its movement up, it could change direction moving back towards the upwave line, or could just remain in this resting period. Price makes its decision for the moment and starts to head back towards the upwave line in Figure 15. The movement downward is shown by the down channel tape, the thinner red lines, smaller points 1, 2, 3. Now we have two tapes, which could potentially create a shift in the stride of this current upwave. In this situation, price will now either continue its downward movement towards the upwave line, or it will shift back upward and confirm the shift in the stride of the upwave. Figure 16 shows the drawing of potential wave acceleration. The new potential upwave line can now be attached from point 1 to point 3. The upwave line is attached from point 1 to ensure when the line is drawn, it does not cut through any of the preceding price bars. If it was drawn from a lower point than point 1, it would cut through the bars that followed that lower attachment point. From point 1, we move to point 3, which is the lowest point of the down channel tape. Remember the two-tape rule for drawing a wave. The upwave line, point 1 to 3, is duplicated and attached to the high point at point 2. The wave acceleration can only be confirmed if price breaks through point 2. The green line labeled letter A is drawn to show this point, point 2. The last chart in this section, figure 17, confirms the potential upwave acceleration scenario discussed before. This chart now depicts what is called wave acceleration. The solid black lines labeled with points 1, 2, 3 are now shifting upward, showing price is accelerating to the upside. At letter B, price breaks through the line at letter A, which represents the high price of point 2, to which price had to break to confirm upwave acceleration. This concludes the discussion of the wave lines, the second intermediate level in our trading system. Each level in our system builds upon the other, and it's imperative that the concepts and rules here are completely understood before moving forward. It might be helpful at this point to move back to the tape level and then review the wave level once more before moving forward to the next section. As always, practice, 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 practice with the drawing of tapes and waves. It may seem difficult, but it will get easier the more you study and as more examples are provided within this video. The final level to be built out in our system is the trend, and it is tracked with trend lines. For a trend line to be created, we must have two completed waves. An uptrend will consist of an up wave followed by a down wave whose low does not break the lowest low of the up wave, hence creating a higher low point. A downtrend will consist of a down wave followed by an up wave whose high does not break the highest point of the down wave, hence creating a lower high point. Trend lines help to track these wave highs, lows, lower highs, and higher lows, which are called swing points. Trend lines track the longest term buying and selling interest in our system and assist in creating a market structure. We know that waves move in channels, and the same can be said for trends. Like waves, trends have associated overbought and oversold areas, which help reveal potential reaction points within the said trend. Uptrend lines and their overbought lines create an up channel. Downtrend lines and their oversold lines create a down channel. These channels determine the longer-term state of the market, providing context for potential trading opportunities. First, let's look at an uptrend. Figure 1 shows an uptrend. In this example, 3 different line weights can be observed. The thinnest lines, lightest weight, representing the tape level or the shortest term level. The next thicker lines, the medium weight, representing the wave level or the intermediate level. And the thickest lines, the heaviest weight, represent the trend or the longest level. We know that to make a wave, we need to have 2 opposing tapes. Moving from left to right, we have an up tape followed by a down tape, the lightest lines. This creates the potential for an up wave, which is confirmed by the next up tape. This up wave that is formed continues to move higher until the up wave line, the medium black line, is broken by a down channel tape. As we continue to move to the right of the image, an up tape is created with a high point lower than that of the previous down tape. This creates potential for a formation of a down wave, the medium red lines. The down wave is confirmed by the next down tape. At this point, we now have a potential uptrend due to the fact that we have completed an up wave and have confirmed a down wave. The uptrend is confirmed once there is a break of the down wave line, the medium red line. The break is shown by the final up tape at the far right of the image. The uptrend line, thickest black line, is then copied and placed at the highest high point in this example. This is the uptrend overbought line. Let's take a look at how an uptrend channel is formed using a real-life example, building from the tape level to the wave level, and finally to the trend level. In Figure 2, we have two opposing tapes, one up channel tape and one down channel tape. Figure 3 shows the creation of an up wave by connecting the up tapes to the down tape. In Figure 4, we first see that the up wave expanded, which is shown by the long price bar breaking through the initial up wave overbought line. Following this expansion, a down channel tape is created and price moves back down towards the up wave line. In Figure 5, we now have a new up channel tape, black dotted lines, and a new down channel tape, red dotted lines, creating potential wave acceleration. This is shown by the up wave line and the wave overbought line now angling up further to the upside. In Figure 6, the overbought lines have been deleted for ease of viewing. This image shows how price within the down channel tape, red lines, breaks through the prior up wave line, thicker black lines. This is an alert for the potential change in the stride of price. In Figure 7, we now have two opposing tapes, the down channel tape that broke the up wave lines, and now an up channel tape. This creates a situation for the creation of a potential down wave. Skipping ahead a bit, we see the down wave was confirmed because we broke the low point of the down channel tape shown at letter A. Letter B represents a point where the down wave line was tested, but there was no follow through to the upside. In fact, price turned all the way back down to test the oversold line thereafter. Figure 9 is showing down wave expansion at letter A, which is an indication of increased weakness. In Figure 10, after the down wave expansion, price turns back up towards the down wave line via an up channel tape, thinnest black lines. This up tape breaks the down wave line, and we now have two completed waves, an up wave and a down wave. In Figure 11, we have the creation of a potential uptrend. We have the two opposing waves necessary for the formation of the uptrend channel. The uptrend channel line is drawn between points 1 and 3, attaching the swing low points, point 3 being the higher low point. This line is duplicated and attached at the highest swing high point between the two waves at point 2. This is the uptrend channel overbought line. In Figure 12, there is confirmation of the uptrend. Price made its way all the way back up to the overbought line and broke through the prior swing high point. Letters A, B, and C represent the expanding, accelerating move that brought price up to letter D at the top of the trend channel. Let's now take a look at how to construct a downtrend channel, which is created just like an uptrend channel, but now the trend will be sloping to the downside. Figure 13 shows a downtrend. In this example, like the uptrend example, 3 different line weights can be observed. The thinnest lines, lightest weight, represent the tape level, shortest term level. The next thicker black lines, the medium weight, represent the wave level, the intermediate level. And the thickest lines, the heaviest weight, represent the trend, or the longest level. Again, to make a wave, we need to have two opposing tapes. Moving from left to right, we have a down tape, followed by an up tape, which are the lightest lines. This creates the potential for a down wave, which is confirmed by the next down tape. This down wave that's formed continues to move lower until the down wave line, medium red line, is broken by an up channel tape. As we continue to move to the right of the image, a down tape is created with a low point higher than that of the previous up tape. This creates the potential for the formation of an up wave, or the medium black lines. The up wave is confirmed by the next up tape. Now we have a potential downtrend due to the fact that we have completed a down wave and we have a confirmed up wave. The downtrend is confirmed once there is a break of the up wave line, the medium black line. This break is shown by the final down tape at the far right of the image. The downtrend line, the thickest red line, is then copied and placed at the lowest point in this example. This is the downtrend oversold line. Figure 14, we skip ahead a bit to the confirmation of the first down wave. We had the initial down channel tape followed by the up channel tape, which turned back down to letter A. Price then broke the low point marked by the green line to confirm the down wave. Our down wave oversold line was plotted and price traded lower to test that line. Figure 15 depicts an accelerated down channel tape which expands the down wave. This expansion is marked with the dashed line at the bottom of the image. In figure 16, price turns up from the expanded wave oversold line in the form of an up channel tape. In figure 17, with two opposing tapes, one down and one up, in place, the stride of the down wave is now accelerating lower. This is shown by the increase in the downward slope of the wave lines. We skip ahead a bit further in figure 18, where the accelerated down wave line was tested twice. The tests are labeled with letters A and B. After the test, the next up tape, the black lines, breaks both the accelerated down wave line and the original down wave line that were drawn in. This alerts us of a possible change in the stride of price. In figure 19, we have the potential for an up wave to be created. We have our up channel tape followed by our down channel tape, the thin red lines. In figure 20, we confirm the formation of the up wave as price breaks the prior high point of the up channel tape labeled with the green line. Figure 21 depicts up wave expansion. Figure 22 shows how the up tapes can be drawn in on the ride up. Also, in figure 22, we see the down channel tape break the up wave line. We now have a completed down wave and a completed up wave. This provides us with the necessary information to create a potential downtrend channel. Figure 23 represents the potential downtrend channel shown by the thickest red lines. The downtrend channel line attaches the two swing high points, one being a lower high. This line is duplicated and attached to the lowest low point. That line is called the downtrend oversold line. Figure 24 shows the confirmation of the downtrend channel. The next down wave travels all the way from the downtrend line to the downtrend oversold line, breaking the prior low. This, by rule, confirms the downtrend channel. In conclusion, it's imperative to have a sound methodology for drawing these lines when tracking the movement of price in real time. Following the rules for drawing each set of lines in the manner described in this video creates a framework for consistency. This consistency eliminates the potential for creativity and indecision. The lines are there to provide us with insight and indications of the probable movement of price. Lines drawn haphazardly will do nothing more than create confusion and disorder in our trading environment. We must remember that the purpose of drawing lines is to help the trader find order in all these price points and tell him whether price is going up or going down. Let's take a look now how we can put this all together and create a structure for the market. The purpose behind drawing these lines is not to make the chart look pretty, but to draw the trader's attention to those areas, zones, points, levels, where price action is most likely to provide trading opportunities. Whether one draws lines, boxes, circles, arrows, or big pointy fingers is irrelevant. Until price reaches an area where a trading opportunity is most likely to occur, there is no reason to obsess over the minor ebbs and flows. However, once trading opportunities are on the horizon, what might be considered directionless activity elsewhere suddenly becomes important. How do we determine where to look for these opportunities? How do we take tracking waves a step further to better determine expected behaviors in price action to alert us of these potential opportunities? How do we further build a structural process to put all this into context? These questions will be answered in the next few slides. Okay, let's dig a little deeper into wave anatomy. We know thus far that each wave has a high point, a low point, and a midpoint associated with it. We also know that each wave will have an associated wave line, that being a supply line or a demand line, and a corresponding overbought or oversold line. We have yet to discuss the types of actions that are associated with these trading waves. Just like the bones and muscles of the body, waves have a specific anatomy, but also produce specific actions. The types of actions that can be observed with trading waves are turns, breaks, and pullbacks. Turns describe points where one wave potentially ends and an opposing wave potentially begins. These turns can and often have a general structure, but at times can be abrupt and surprising. The breaks can be defined as the breaching of a drawn line, that being supply, demand, or trend line, or the breaching of a high, low, or midpoint. These breaks potentially confirm the opposing wave's turning point. Pullbacks can be a sort of a test or resting place for price after the turn and break have taken place. In a pullback, price retraces some or all of the move opposite the direction of the break. If price breaks to the upside, a downside move would be considered a pullback. These pullbacks provide opportunities for those to enter the market that may have missed trading the turn or the break. It should be noted that there can and will generally be multiple pullbacks within waves and trends. Let's examine now the types of turns. In our system, there are 4 types of turns we are interested in, and generally these will encompass a majority of the turning points a wave can achieve. These turns can be generalized to be called W's, M's, V's, and reverse V's, or almost like an N type shape. One must not focus so much about the shapes, but more so on their actions. The images here describe the types of W turns. These actions depict turns to the upside. In the false break turn, letter A sets the initial lowest low point of the down wave. At letter B, we test letter A, breaking below the low point at letter A. However, there's no follow-through to the downside. This dynamic can trap sellers who sold the break of letter A and also force those who bought too soon prior to the test of A to exit their position early. This is called a shakeout. When price turns up, the weak buyers are now out of the stock, and the sellers that sold too soon have to buy back what they sold to cover their losing positions, propelling the price upward. In the double bottom, letter A again sets the initial lowest low point of the down wave. At letter B, we test point A, but this time enough demand is there to hold price at letter A, and price does not drop any further. The low points are now equal, hence the name double bottom. Supply is still coming in on the test of letter A. However, there is enough demand to absorb that supply. Price will then rise if the demand for the stock continues to outweigh the supply. In the higher low turn, letter A sets the initial lowest low point of the down wave. At letter B, this time, the selling pressure is not great enough to get price back to letter A. Now this can be for 2 reasons. First, sellers no longer believe the price will trade lower and supply is withdrawn. which also slows the decline of price. Secondly, the buying pressure or demand on the move back towards letter A is so strong that it absorbs and overcomes all of the selling pressure to halt the decline of price. Now, the reverse of these actions is seen in the M turns. These depict turns now to the downside, very similarly to the W terms, but just flipped over. In the false break turn, letter A sets the initial highest point of the up wave. Letter B, we test letter A, breaking above the high point of letter A slightly. However, there is no follow-through to the upside. This dynamic can trap buyers who bought the break of letter A and also force those who sold too soon prior to the test of point A to exit their positions early. This is called a shakeout or an upthrust. When price trades down, the weak sellers are now out of the stock, and the buyers that bought too soon have to sell what they bought to cover their losses, propelling price downward. In the double top, letter A again sets the initial highest high point of the up wave. At letter B, we test letter A, but this time enough supply is there to hold price at letter A, and price does not increase any further. The two high points are now equal, hence the name double top. Demand is still coming in on the test of letter A, however, there's enough supply to absorb that demand. Price will then decline if the supply of the stock continues to outweigh the demand. Selling pressure can be said to be greater than buying pressure at this point. In the lower high turn, letter A sets the initial highest high point of the up wave. Letter B, this time, the buying pressure is not great enough to get back to letter A. This can be for two reasons. First, buyers no longer believe the price will trade higher, and the demand is withdrawn, which slows the rise of price. Secondly, the selling pressure or supply on the move back towards letter A is so strong that it absorbs and overcomes all of the buying pressure to halt the rise of price. The last turns we will discuss are the V turns. The V's can be considered sharper, less predictable turns to the upside and downside. With the V turns, we will call them the V turn up, since it resembles a V and turns price up, and the upside down V or N-type turn, we will call the V turn down because it resembles an inverted V and turns price down. These turns can also appear like U's and N's, but the shape as stated above is not important, only the action. These types of turns are extremely difficult to trade in real time because there is no reference point within the wave to go by. The only real way these types of turns become tradable is if this V testing action occurs at a prior support or resistance area. Otherwise, without the second test, the letter B in the turns of the prior images, there's no landmark to base our risk off of. What tends to happen in the V turn up is as price is moving lower, the demand is initially withdrawn, which allows for a rapid decline of price. Once specific price levels are hit as price moves lower, demand begins to increase further and further until the terminal endpoint. This point is usually abrupt and is associated with a lot of trading activity. This activity can sometimes be called a selling climax or just generally climactic action. The reverse happens in the V turn down. As price moves higher, supply becomes scarce, creating a rapid rise in price until the point when supply begins to come in with full force. This action halts the rise in price as selling pressure becomes greater and greater. Like the V turn up, this turn is usually abrupt and is associated with a lot of trading activity. This activity can be called a buying climax. Now, a quick word on climaxes. We can never know if the action we are observing will be the real climax or the end point of the wave. We'll only be able to know this in hindsight, after the fact, after the turn. This is why it's so difficult to trade. Next up in our Wave Anatomy 201 class, we'll discuss the breaks. These breaks can be a break of one of the lines we've discussed earlier, or a swing high or swing low point. These breaks confirm a turn has taken place, but they are only an indication of potential change in direction and not necessarily an all-out reversal. So for the up breaks, very simply, each of these wave turns is confirmed by the breaking of the line and or the prior swing point. In the first three images, moving from left, both the line and the prior swing high point are broken at letter C. In the fourth image, we see the break at letter B. It should be noted that what is important in observing these line breaks and swing points is not the break itself, but how the breaks occur. Are they feeble? Are they strong? Are they accompanied by a lot of trading activity? Answering these questions provides us insight into the buying and selling dynamic. Now let's take a look at the down breaks, which is basically the reverse of the up breaks. In the first three images, moving from left, both the line and prior swing low point are broken at letter C. In the fourth image, we see the break at letter B. Again, like the up break, it's not the break that is of most importance, but how the break happens. The final piece of the puzzle are the pullbacks. As stated earlier, the pullbacks are a retracement from the break that allows traders another opportunity to get into the stock in the direction of the break. When lines or swings break to the upside, the pullback will essentially pull back to the downside. When lines or swings break to the downside, the pullback will pull back to the upside. Here are some examples of pullbacks leading to the formation of an up wave. The first three images from the left show the turns at letter B, the breaks at letter C, and now the pullback at letter D. At point D in the first three images, we get the higher low point that we would need to create the potential up wave. As we break the dotted black line marked at letter E, we can now confirm an up wave has been created. The fourth image shows the turn at letter A, the break at letter B, and the pullback at letter C. The same rules apply. Letter B breaks the down wave line or supply line. Letter C represents the higher low point, which at that point we need to create an up wave. Breaking the dotted line marked by letter D confirms the up wave since we broke the highest point of the first move that broke the line at letter B. Now let's take a look at the pullbacks to the downside. The first three images from the left show the turns at letter B, the breaks at letter C, and now the pullbacks at letter D. The move at letter C breaks the up wave or demand line, indicating potential change from up to down. At point D, in the first three images, we get the lower high point that we would need to create a potential down wave. As we break the dotted black line marked at letter E, we can now confirm a down wave has been created. The fourth image shows the turn at letter A, the break at letter B, and the pullback at letter C. The same rules apply. Letter B is the move that breaks the up wave line or demand line. Letter C represents the lower high point that we would need to create a down wave. Breaking the dotted line marked by letter D confirms the down wave since we broke the lowest point of the first move that broke the line at letter B. Remembering from all the way back in the beginning of this that price movement is continuous. There is always an underlying ebb and flow of all of the waves, big and small. Tracking price in all of the ways described thus far helps put these movements into context and helps keep us in sync with this flow. The general structure is waves turn, then they break, then they pull back, then they continue onward or fail in reverse back in the original wave's direction. These movements are business as usual for waves. When a wave exhibits what could be a potential turn, we know a break of some sort must be next. If and when the break does occur, we know and should expect to see pullbacks. These are the natural movements of waves. If we did not see these types of actions, that should alert the trader that something is amiss and it might be wise to stand aside until a picture of clarity presents itself. The images above do provide insight into the movement and anatomy of waves, but it is certainly oversimplified. The market will not always paint beautiful images like the ones drawn above. Let us examine how these turns, breaks, and pullbacks can look on real charts alongside their basic drawings. Here is a real-life example of the false break. We see the bar labeled with the letter B breaks through the lowest low in the wave at letter A. When price recovers, it breaks through the down wave line at the bar labeled with the letter C. Letter D represents the low point of the first pullback after the line break. Price breaks through the high point from the move up from letter C, confirming the up wave. The double bottom example does not look as clean as the drawing suggests, but this is more indicative of what can happen with the movement of price. At letter B, price tests letter A and holds its ground. At letter C, we have the break as expected, and letter D, the pullback, also as expected. Price can sometimes take time to shed its skin and reveal its true direction. Price here takes almost 10 days to confirm the up wave, marked at letter E. In this higher low example, we see the higher low at letter B. There is not enough selling pressure to move price all the way down to letter A. Again, letter C represents the break of the down wave line, and letter D, the first pullback after the break. What can be seen here is that after the first pullback, price pretty much takes off to the upside without much pullback thereafter. The up wave here is confirmed at letter E by breaking the high point near letter C. In the V turn up, we can see price gets to a low point at letter A and then simply turns up, breaking the line. There is no test of letter A after the initial turn. Letter B represents the break, and letter C the first pullback after the break of the line. Price then does take a lot of time to confirm the up wave, breaking the line at letter D. Like the higher low example, sometimes price will just take off in the opposite direction. Here we have the other false break, this time leading to the turn to the downside. Letter B tests and momentarily breaks letter A, followed by an immediate break of the up wave line at letter C. Letter D depicts the first pullback after the break to the downside. This represents the potential for a down wave to form. At letter E, once price breaks the low point from that first pullback, at letter C, the down wave is confirmed. These images show the double top. At letter B, we test letter A, but price cannot break through the previous high point. Letter C represents the line break thereafter. At letter D, unlike the other examples, price pulls back a bit further above the up wave line than the previous example. This can happen and is completely fine, as the market is very rarely ever perfect. What is important in the pullback is that the move from letter C to D creates a lower high point. The down wave is then confirmed at letter E, breaking the low point at letter C. In this example, we had another letter, letter F. What can happen at times when price breaks swing points is it can immediately retrace back beyond the previous point that was broken. Price is not always ready to just take off in one direction. Sometimes it needs more fuel. If we remember the information in the earlier chapters, we can observe that this move from letter E to letter F retraces greater than 50% of the move from letters D to E. This is an indication of momentary strength and a warning to our previously confirmed downwave. Once price breaks back through the swing low point represented at letter C, a resumption of the down move is more likely than a reversal to the upside. When price breaks through the low point at letter E, that opinion is confirmed. In this lower high example at letter B, it is clear price is not strong enough to make it back up to test letter A. The break at letter C immediately follows. What is interesting here is that price cascades down so quickly that there is barely any stalling or pullback whatsoever. The highlighted area at letter D represents that stalling. Again, the market is rarely perfect, and if one was waiting to enter on the first pullback after the waveline break, they would have had to pass on this trade, as there was no true pullback available to enter on. At letter E, we get an ever so slight pullback, but at this point, the most opportune time to enter has passed. In this example, we trade up to letter A and immediately turn down, breaking the up wave line at letter B. The turn is confirmed by letter B, followed by the first pullback at letter C. The down wave is confirmed by the breakdown of letter B at letter D. At letter E, as seen in an earlier example, price immediately turns back up above the swing low at letter B, exhibiting momentary strength. This is very short-lived. After price tests the stride of the down wave at letter E, price resumes its original course to the downside. This is confirmed by the break of the low point at letter D. These examples were selected to explain that the market is not always as crisp as a drawing might suggest. Price at any moment in time can do whatever it pleases. Remember, though, that in tracking price with lines and understanding wave anatomy, we are armed with the tools necessary to read the clues that the market provides for us. In this manner, we can and will judge the market by its own actions. Let's talk a little bit now about auction market theory and how that can help us build a structure with our trading. Auction market theory provides us with a framework for answering some of the important questions asked earlier. How do we build a structural process to put the movement of price into context? How do we determine where to look for opportunities to make a trade? Auction market theory helps us to define the varying states of the market, providing structure, and with this structure, assist in locating the possible, most opportune locations to enter a trade. Technically, there are only two market states. Those two states are trending and non-trending. A trend can be determined by its swing highs and swing lows. An uptrend, then, is defined by price making higher swing highs and higher swing lows. A downtrend is defined by price making lower swing lows and lower swing highs. Non-trending states can be described as ranges, hinges, and trend channels. These non-trending states are also defined by swing highs and swing lows. However, each has a different dynamic associated with them. Each of these states will be discussed shortly. Before we continue the discussion on defining the market states, let us take a broader look at what an auction market entails. An auction market is all about price discovery. The market is constantly seeking value and finding value. The structure of an auction market is continuously evolving and being revalued. When a market is finding value, it is said to be balancing or ranging, and when a market is seeking value, it is said to be in a state of imbalance or trending. It must always be remembered that the current price of a market is arrived by the negotiation process between buyers and sellers. One could expect to find support where the most substantial buying has occurred in the past, and resistance where the most substantial selling has occurred. The actual price of a stock is not the same as value. The process of price discovery is the search for value. Value is not real, it is perceived. After all, what is the value of, say, Microsoft or GE or that little stock your barber told you about? This state of affairs may seem like a recipe for chaos, but it is in fact the basis for making a market, that is, reconciling the differences, sometimes extraordinarily wide differences in perceptions of value. If a stock is thought to be below value and traders see a large potential for profit ahead, they will buy all they can at or near the current level, preferably on reactions or pullbacks, so they do not overpay. If the stock is above what they perceive to be value, they will sell it or short it, supporting the price on those pullbacks and unloading the stock on rallies until they are out. This is why these supporting levels and the levels of resistance are so important for you to watch. When price then begins to lose momentum and move in generally sideways directions, you have found value. If value has not been found, then price will not stop advancing or declining until it has. Value then becomes that area where most of the trades have been or are taking place, where most traders agree on price. Price shifts from a state of trending to a state of balancing or consolidation or ranging, the only two states available to it. The trading opportunities then come when price is already away from value and when price decides to move away from its current level of value to another. This all sounds good in theory, as the name implies, and may make one sound intelligent at the water cooler, but how do we track these states and put it all into context? First, let us start with the explanation of what constitutes one of the non-trending market states, the trading range. When traders have a lot to buy and or sell, they will focus on trading around midpoints, as this is where the most trading is taking place. For us retail traders, the best bet for us is to trade near the extreme high or low points of these ranges and avoid the middles, since trading near midpoints is largely non-directional. Too much whipsawing takes place there and tends to generate a lot of losing trades for the retail trader. The extreme high or top area of the range can be called resistance, and the extreme low, bottom area of the range, support. If one is able to determine whether price is in a state of imbalance or trending, or a state of balancing, ranging, and is able to determine range extremes, then they are in business. Here is an example of a trading range and the options we have for trading within and outside of it. In the image here, we see resistance marked by the upper line drawn along the swing highs. This is an area where price continually turns down, moving back towards and through the midpoint, and then back towards the swing low points, the support points. The support points are marked by the line drawn across the low points and are the points where price turns back up towards and through the midpoint, moving back to the old swing high points. From the description and visual in the image, one can see how the midpoint becomes an area where the most trading takes place. Compare the points of contact of the lower and upper lines versus the midpoint, the red line shown. In remembering what was stated before, the trading opportunities will come at those support and resistance points. If one is looking to buy the stock and trade the range, he would buy around the support level. If one is looking to sell or short the stock, he would sell around the resistance level. If one had no interest in trading the range or the value area and would rather seek opportunities as price moves away from value and towards a new value area, he must wait first for either the support or resistance level to break. These breaks are displayed at letters A and D. At this point, there are a couple of options for the trader. There is the option of trading the break or the option of trading the first pullback after the break, if there is one. Letters B and E represent these pullbacks, with letters C and F representing the confirmation of the new waves. Whether price moves up out of the range or down out of the range represents a period of imbalance, seeking new value or trending. Another type of market state is called a hinge. A hinge is a type of range created by successive lower highs and higher lows and represents a tightening and compression of price. While price in a trading range will bounce up and down in search of equilibrium or value with no particular timetable in mind, price in a hinge conducts that search more seriously, giving itself a deadline, i.e., that point, the apex, where the diagonal lines meet. If interest is sufficient, this compression will eventually lead to a worthwhile move. In hinges, there is no aimless drift, but a struggle between those who want to move price ahead and those who do not. Therefore, price should bounce in an ever-tightening range, which culminates in a release of pent-up energy and a tradable move. A particularly attractive feature of the hinge is that it is so easy to recognize in real time. As soon as you note a higher low and a lower high, or vice versa, be on the lookout. A hinge may be on the horizon. Here is an image of a hinge. In the hinge, the upper line connects the successive lower highs and the bottom line connects the successive higher lows. The midpoint, like the trading range, represents the area where most of the trading occurs, and trading in that area should be avoided. One can easily see how the price movement here continues to tighten as it approaches its apex. It's advisable not to trade within hinges due to the fact that the size of the range is continually decreasing. A better option would be trading the breakout of the hinge, either up or down, as at that moment the energy that has been pent up should be released. If one does not want to trade the breakout, like the trading range, one could wait for the first pullback thereafter if there is one. If there is a pullback and it confirms a new wave, either up or down, price again would be considered to be in a trending environment seeking a new level of value. The images that follow put these ranges, trends, and hinges into greater context. In the example here, we see how price starts off in a trading range. Leaving this range creates an uptrend move in price. Once price reaches a level where traders agree upon price, the market creates a hinge showing this agreement. At the point of the hinge, the market can continue its prior direction, moving back up in a trending state, or it can reverse its position and move down in a trending state. In this example, price begins to trend down. Again, price will continue to move down until traders begin to agree on price. This agreement is found and seen at the point of the next trading range. Finally, price can break out to the downside of this range, continuing its prior movement, or it can change its mind and reverse its position. In this example, price then reverses its position once more, moving back up in a trending manner. The image here is the same image as the prior one. However, instead of referring to the market states as trending and ranging, they are labeled as value and seeking value. At first, the market finds value trading within the range. Price then decides it's done trading in that value area and decides to seek value higher via an uptrend. As price moves higher and higher, it begins to move sideways, again finding value in an ever-tightening range, also called the hinge. When the traders did all the trading they had to do in that value area, the perception of value is lower, so price seeks new value to the downside in the form of a downtrend. Value is then found again at lower prices, and price moves into a new trading range. Finally, the business in that trading range is completed, and price seeks value at higher prices thereafter in an uptrend. In the prior images, there was a point, the hinge, where price could have broken out to the downside or broken out to the upside. The image labeled continuation shows what the opposing action would have looked like. If price decided there was further value higher, price would have broken out of the top side of the hinge and the uptrend would have been continued. The image here labeled reversal shows the other potential action, a reversal. It was determined that there was no further value to the upside and price reversed its path back to the downside to see if value could be found there. A way to put the trending state of the market into context would be in the form of a trend channel. Now, although they are called trend channels, they are ranges of sorts. Essentially, they are ranges with a specific slope. Like trading ranges, the greatest amount of volume or activity takes place in the middle of the trend channels. The uptrend line and its overbought line, as well as the downtrend line and its oversold line, act as extremes of the channel, much like support and resistance levels of a trading range. The image here provides a visual example of the development and trading around channel extremes. It can be observed in this image that price moves off its uptrend line and back up towards and tests its overbought line. Once it reaches the overbought line, price reverts back towards its uptrend line until enough supply, weakness, or selling pressure is exhibited in price to break the uptrend line. Once this happens, price creates a down wave followed by an up wave, which we know creates a trend channel. From there, price tests its oversold line, an extreme where demand may show itself. In this case, enough demand comes in to move price back towards its downtrend line. Here is an example of a longer-term trend channel. In this example, we can see some of the concepts discussed much earlier in this video. That is, there are waves within waves within waves. All of these waves create the ranges, the hinges, and the trends. In a longer-term trend channel like this, a few things can be observed. First, potential support and resistance now lie at the extreme ends of the channel. This is different than a range because the extremes will move with time since they have a slope and are not completely horizontal. The midpoint will also move with time. The best opportunities to buy would be at or near the bottom of the trend channel, and the best opportunities to sell would be at or near the top of the trend channel until the stride of the channel is changed. Again, the midpoints of these longer-term channels and ranges should be avoided. What can be noticed in this example is the indecision in the movement of price, as shown by the smaller ranges and hinges around the longer-term channel midpoint. A word now on two of the most used words by those who track price via charts: support and resistance. Support and resistance are not points where demand will overwhelm supply or vice versa. Rather, they are points, levels, or zones which the movement of price might be affected due to the fact that price was affected there earlier by demand overwhelming supply, or vice versa. In other words, a swing high occurs because supply overwhelms demand, at least for the time being, but one cannot assume that a swing high is going to act as resistance simply because it's a swing high. It must also act as resistance in order to be resistance. If it doesn't, then it isn't. Again, this is not to say that highs, lows, round numbers, etc. aren't potential support and resistance points, but they're not actually support or resistance until they actually provide support or resistance. A swing high or low represents a point at which traders are no longer able to find trades. If there is nothing going on above the current price or nothing going on below the current price, then it will return back to an area where trades can be found. This is where those value areas come from, described previously. Whether any of the swing points represent important support or resistance will be seen the next time traders push price in that direction. Important support and resistance levels can be found at those levels or zones in which a relatively large number of trades took place. For example, if a given level is hit repeatedly and price is supported there by professional buying, that level becomes strong support. The same goes for resistance. There will be a level at which shares are repeatedly sold, though the reason for the sales may be difficult if not impossible to determine. Put simply then, support is the price at which those who have enough money to make a difference are willing to show their support by retarding, halting, and reversing the decline by buying. Resistance is the price at which those who have enough money to make a difference attempt to retard, halt, and reverse a rise by selling. Whether one calls this money professional or big or smart or institutional or crooked or manipulative or fill in the blank is irrelevant. If repeated attempts to sell below this support level are met by buying, which is sufficient to turn price back, these little reversals will eventually form a line or zone discussed earlier. The same goes for resistance. Let's take a look at an example of swing points and how they can relate to trend, support, and resistance. The image here depicts how swing points can eventually become support or resistance and build a trading range or value area. For all intents and purposes, letter A is considered our first swing low point. From there, price trades up to letter B. At letter B, buyers are no longer interested in trading at higher prices. No further transactions have taken place above B. Since the business of trading is finding trades, price must revert back to a previous point where more trades can be found. When this happens, price typically reverts back towards a midpoint, or 50% of the prior swing, or a halfway point, as discussed in the waves sections. Letter C represents this midpoint and is tested by letter D. At letter D, more trades are found, and the demand is strong enough to drive price back up for a test of letter B, where potential, but not definite, resistance might be met. Letter E represents this test, but in this instance, either the demand is withdrawn or supply is overwhelming demand. This price area, letters B and E, can now be considered resistance. Regardless of the reasoning, at letters B and E, the selling pressure is greater than the buying pressure, so price must again revert back towards a middle ground. This is seen by letter F. Price futzes around a little at letter F before trading back to letter A, representing a test of the prior swing low point. Price holds there at letter G, a level now considered to be support. Price has created a trading range or value area, with letters A and G being the lower extremes or support points, and B and E being the upper extremes or resistance points, with letters C, D, and F being the midpoint of the range. If this range is to hold for a period of time, one can expect an eventual test of letter H, although there are no guarantees. This next image here presents a scenario that can and will happen in the market, a trend continuation. In the building a range example, we already discussed what letters A, B, C, and D represent. Let us fast forward to letter E, where a different behavior is observed. When price travels back towards letter E, two things can happen at that inflection point. Price can either trade through it or it can turn away from it. In the previous example, we saw how price encountered resistance and was turned away from trading higher through letter B. In this situation, this time, price does not encounter resistance in its advance. At letter E, price breaks through B and confirms an uptrend continuation. This depicts how testing a prior swing point is not always a guarantee that price will exhibit the same behavior as prior and be supported in its decline or resisted in its advance. Letters X, Y, and Z represent a pullback and wave confirmation after the break of letter B. We know from our studies that when points or lines break, one can expect a pullback thereafter. Letter X then is the high point of the breakout, letter Y the low point of the pullback, and letter Z the confirmation. Step by step, let's investigate a real-life example of how to build and track price via its given structure. In Figure 1, we have our first upswing spanning from letters A to B. In Figure 2, no trades were found above letter B, so price reverts back to where more trading can be found. In this case, price drops back below the midpoint of swing AB, nearing a test of letter A. Price holds at letter C and turns back up. This creates our initial uptrend channel. Figure 3 confirms our trend channel. The uptrend line is attached to letters A and C, and it is duplicated and attached to letter B. We can see how the swing C to D moves all the way back up to and even slightly through the overbought line of the uptrend channel. We also see a slight break of the swing high point labeled letter B. If the stride of price conforms to channels, breaking of swing points will happen. At this point, price can continue its move upward, or if it's overbought or encounters resistance, price will revert back towards the midpoint or possibly to the uptrend line labeled A to C. Figure 4 shows how price does revert back to the midpoint of the channel at letter E. Same options as always, up or down. Price can move back up to test the overbought line, BD, or can trade lower to test the uptrend line, AC. The midpoint holds at letter E, and price trades higher to retest the overbought line at letter F, where it's again turned back down to the midpoint. In Figure 6, this time price trades through the midpoint, where it's held up on a test of the uptrend line, labeled AC, at letter G. If price holds letter G, then the stride of this up channel will be intact. Price is supported at letter G in Figure 7, and again tests and holds the midpoint of the up channel at letter H. It should become a bit clearer now how the midpoints are where a majority of trading takes place. It should also become clearer how all of the trend lines shift as time passes. In Figure 8, at letter I, we can observe a test of the minor swing point at letter G and the test of the uptrend line. It should be noted that these lines and points should be treated more as areas or zones rather than exact pinpoints. We see here at letter I that price breaks through both the point at letter G and through the uptrend line. What is important here is not necessarily the break, but how price breaks these areas, and also how price reacts after the break. Here, price bounces right off these areas, an indication of support. Had price plummeted through this area after the initial test, then the stride of the channel would have been broken and new weakness would have been shown within the market. We have seen this action now in Figure 9 repeatedly, how price holds the extreme and trades back towards and through the midpoint of the channel, shown at letter J. Count the touches of the midpoint versus the touches of the extremes. At letter K in Figure 10, demand has been strong enough to drive price back up to the overbought line and is now currently testing the upwave line, the line from letter I through J. If price holds this upwave line or demand line, we would see another test of the overbought line and possibly a test of the swing high point associated with letter K. For the first time in this sequence, Figure 11 represents a situation where we have substantially traded through either of the lines of the trend channel, showing an increase in the strength of price. However, with that said, we see a deceleration in the up move shown by the downward fanning of our original upwave line or demand line. This shows a weakening in the upward stride of price. From that point, we get a break of this said upwave line approaching letter K for a potential re-entry into the uptrend channel. If price does re-enter this trend channel, where would price likely look for more trades? If you answered the question above with the midpoint of the trend channel, you would have answered correctly. This is exhibited at letter M. Price then turns up, showing a bit of a different behavior. Price appears to only trade back up a bit above an old swing point at letter D. Although the channel has been our main focus, we must still keep an eye on all of the landmarks. Price pulls back after the break of the up wave line, but only trades marginally higher than letter D at letter N. This is an interesting dynamic and could mean price will confirm a wave to the downside. On the way down to letter O in figure 13, we get the confirmation of the down wave. Our down wave, or supply line, is drawn in from letter L to letter N. At letter O, we have a test of the uptrend line. Like at letter L, price breaches the line a bit more than normal. We have a situation now where price seems to be reaching. It wants to go a little higher than normal and wants to go a little lower than normal than its current stride. This is all part of the price discovery process. Price will poke, prod, bounce, turn, and break through these areas in search for more trades. That's what it does. At letter O, there are a couple of opinions we can have. First, we see here price starts to pull back off the low point at O. Price can trade up a bit higher and then resume its move lower, which would create an accelerated down wave. The other option is price can trade back to test the down wave line, letters L to N, which at this point is associated with the midpoint of the uptrend channel. As it turns out in figure 14, price does move up and is testing the down wave line L to N, at letter P. What you might notice in figure 13 is the down wave line was at nearly the same level as the midpoint of the trend channel. Again, because of time, these diagonal lines shift, incorporating time as part of the stride of price. Currently, price is halted at the down wave line, just ahead of the test of the midpoint of the channel. This down wave line now interacts with an old swing high point at letter B. These swing points can become important at a moment's notice, providing us with further information about the strength and or weakness of price. If price holds at letter P and trades lower, the current stride of price of the uptrend channel may be in jeopardy. After the turn at letter P, we had a situation of opposing forces. We have had an uptrend channel now for quite some time, with its uptrend line being tested several times, which can be an indication of weakness. The question here is how much longer can buyers support price in this channel? Comparatively, we've had a down wave now that has maintained its stride and is also of a longer extent than any of the previous down waves, exhibiting even greater weakness in price. Let's remember a concept discussed earlier when speaking about breaks of lines or breaks of points. It's not necessarily about the break itself, but how the break occurs. We can see here, moving from letters P to Q, there is a precipitous, rapid decline in price. This action pretty much tells us that price is absolutely done trading in this channel and is seeking value somewhere else. Where are the next landmarks that can impede the progress of price? Those are the swing low points at letter A and letter C, drawn with horizontal lines spanning across the chart from left to right. At letter Q, there is some overlapping action of the price bars, indicating that for a handful of days, price was trying to decide its next course of action. Will buying pressure be greater than selling pressure? If so, price will rise and potentially make its way back to the down wave line. Will selling pressure be greater than buying pressure at this point? If so, price will trade lower, exploring new territories. In figure 16, selling pressure was greater than buying pressure, so price moved lower to letter R. The line from letters P to Q represents an accelerated down wave. An increase in the acceleration of a wave can indicate greater strength or weakness, in this case weakness, but if the acceleration is too fast or too great, it can be unsustainable and a move in the opposite direction could be in the works. Letter R is a new swing point. At letter R, price finds no trades lower and begins to trade back up. The move from letter R to S represents a new up wave in figure 17. The accelerated down wave line was broken after the move up from letter R, which is the first indication of a potential change in the stride of price and also a momentary indication of strength. When we reapproach the swing low points at letters A and C, price exhibits a very similar behavior to that at letter Q. It is good practice to look at whatever happened before at specific landmarks and initially expect the same thing to occur. It's wise to do this so you're ready for what could possibly happen. It's also wise because if you do not see what you expected to see, that will also provide substantial information. Now, at these prior inflection points, letters A and C, there is a decision to make. Price will trade higher or price will trade lower. Price decides to move higher this time, stopping at an old swing point at letter O. There is a phenomenon exhibited by price where an old level of support can become a new level of resistance and vice versa. In this case, we see the old support point at letter O appears, for the moment, to be new resistance at letter S. So if no trades are found above the high point at letter S, price will turn back down. In figure 18, price does turn down from letter S and again stops at the old swing points from letters A and C at letter T. The swing points at letter A and C are proving to be of relative importance. Remember, price is always giving us clues, providing information on where it's comfortable trading by continually reverting back to those points. If price is not comfortable trading in an area, it will quickly move away from it. In figure 19, at letter U, we get a marginal poke higher, testing the waters above to see if there are any trades to be found there. Price appears to be holding the old swing point at letter O pretty well, as seen by the amount of overlapping of the price bars. Price has spent about 9 days testing, poking, and prodding that specific point. Our stride in this situation is still to the upside, although it's decelerating. We skip ahead now a bit to figure 20. Price is now hovering around that interesting area associated with all of the prior swing low points, those letters being A, C, G, I, and O. Look at those letters and look at what price is doing now at the far right of the chart. Buyers are buying this stock thinking price will trade higher than its prior support points, and sellers are selling the stock thinking the old support points will now become resistance and price will move lower. This shows how traders agree that there is value trading at these levels. If there was no value here, price would not be spending as much time as it does in this area. If you noticed from our earlier discussions, the letters T, U, V, and W depict a hinge, a compression of forces of supply and demand. Who's buying, who's selling, who thinks prices are going higher, who thinks prices are going lower. Eventually, one side will win and the stored up energy in this hinge will be released. Figure 21 illustrates what can often be an aggressive release of the pent-up energy inside of a hinge. Moving from letter W to X, we see a rapid precipitous decline in price back toward letter R. This happens because the buyers who bought on the way up from letter R to S and those who bought within the hinge now have to sell out of their positions, some to bank profits and some to avoid larger than necessary losses. There are also sellers who are selling short the stock looking to make a profit on its downside movement. This dynamic, where the selling pressure far exceeds the buying pressure within the stock, creates a cascading effect. Price accelerates so quickly to the downside that there is an initial bounce at letter X near the swing low point at R, primarily from those that sold within the hinge or on the decline, buying back what they sold to take quick profits. We see a shallow pullback at letter Y and a confirmation of a highly accelerating down wave breaking through letter X. This confirms there is no demand in sight for this stock. In our final chart for this section, the precipitous decline in price continues, and price holds this accelerated down wave line until the low point at Z, followed by a break of the down wave line. What is to be noted here is the steeper the lines become, the easier they are to break. So these breaks must be put into further context. They can be broken by minor bouts of profit taking, or the demand can be real and price is ready to move in the opposite direction. Again, how price breaks and trades around these points will provide that further information. In Figure 23, all of these lines have been removed. It's sometimes easier to visualize the movement of price without the lines crisscrossing in what appears to be chaos all over the chart. Take the time now to study Figure 23 without the use of lines and focus more on the ebb and flow of the chart using the lettered points as references. Let's take a look now at an all-important topic in trading, trading psychology. First, we'll start with fear. Traders will find it next to impossible to work their way through a typical book, course, or manual on trading without being exposed to the subject of controlling one's emotions. This is probably a good time to have that discussion. Thus far, we've talked at great length about the technical aspects of trading, and this seems like a good point to, like the market does at times, digest. A change of pace, of scenery, to give the brain a little rest. Controlling one's emotions is absolutely essential to trading success, but contrary to conventional wisdom, emotions are not an unavoidable component to trading. By emotions, the Y's are referring to the big three: fear, hope, and greed, and withstanding all of these, much less controlling them, can seem insurmountably difficult. Hope, however, is only the fear that all will not turn out as expected or anticipated, and greed is the fear that one will either miss all that a particular opportunity may provide, or that he will miss the opportunity altogether. Fear is the nexus. Fear of what? Left to its own devices, fear can be invasive and seem all-encompassing, but if we examine it closely, we can see that fear, with regard to trading, can be reduced to two elements: fear of being wrong, or ego damage, and fear of losing money, or destitution. Focusing on fear in this manner makes it manageable, even dispensable. Why? Because if one has a consistently profitable trading plan, there is nothing to be afraid of, if one follows it. New traders are to be envied. They have nothing to unlearn and have no preconceptions. If they are curious, able to concentrate, are reasonably intelligent, and are able to work without investing their ego in either the process or the result, fear has no opportunity to intrude. If they are working with the aforementioned plan, trading emotionlessly becomes a matter of course. Experienced traders, struggling, perhaps failing, on the other hand, know a great deal that is not so, which thus has to be unlearned. They are also a bundle of nerves, obsessively questioning their perceptions, their decisions, their actions, or just as likely, their inactions. Running through their heads almost without pause are the voices, so-and-so says, or I read somewhere that, or I took this seminar once that, or this book said. They have spent an embarrassing amount of time, and maybe even money, in search for instructions as to where exactly to draw the line, exactly where to enter, exactly where to exit. This search for exactitude also motivates the search for the exact stop, an exact type of stop that they should use, along with the exact trigger and the exact target. Learning how to trade properly from the beginning with the aforementioned trading plan would have enabled struggling traders to avoid all this turmoil and become consistently profitable, if not at the outset, then close to it. First, realize that the fear of being wrong and the fear of losing money can be consolidated and simplified further by becoming acquainted with their father, the fear of the unknown. By this, I'm not referring to the fact that the outcome of any particular trade is unknowable, though that's true. I'm referring to the fact that struggling traders rarely understand just what they're looking at. Second, they must know just what it is they're looking for. If they did not know what they're looking for, they will not recognize it when they see it. If they did not recognize it when they see it, they of course will not know what to do with it. If they did not know what to do with it, it's a cinch that whatever they do will likely be the wrong thing. Not only will they be doing the wrong thing, they will be doing it at the wrong time. Doing the wrong thing, if they're doing it at the wrong time, will very likely lose the money. Third, the task then becomes to transform the fear of the unknown into a confident ease with the known. This is accomplished by developing, you guessed it, a consistently profitable trading plan. In order to realize a consistently profitable trading plan, one must thoroughly test the elements that go into it. In order to thoroughly test those elements, one must define them precisely. For example, what is a range? What is a breakout? Once one knows exactly what they're looking for, they will know it when they see it. When they see it, they will know exactly what to do with it. Fear becomes irrelevant. The trader may in fact be so focused on their plan that they are not even aware of fear's departure. Let's talk now about how we can start to trade emotionlessly. Trading is a sequence of small financial decisions. If you have not done the prep, you get to take a pass-fail emotional test every time you sit down to trade. This repeats over and over until you work through those issues. Once you have done so, trading is emotionally void, and the risk of trading emotionally is effectively zero. This heightens your awareness and perception of the market during trading. To trade rationally and objectively, you must possess strong supporting beliefs. Supporting beliefs can totally eliminate emotional trading at the moment you completely internalize them. We must always remember the 5 fundamental truths in the market. Anything can happen. You do not need to know what's going to happen next in order to make money. There's a random distribution between wins and losses for any given set of variables that define a strategy. A strategy is nothing more than an indication of a higher probability of one thing happening over another, and every moment in the market is unique. Couple the 5 truths with the following 7 principles of consistency, and you have a recipe for emotionalist trading. First, I objectively define my strategy. Second, I predefine the risk of every trade. Third, I completely accept the risk or I am willing to let the trade go. 4, I act on my strategy without reservation or hesitation. 5, I pay myself as the market makes money available to me. 6, I continually monitor my susceptibility for making errors. And 7, I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. It's impossible to trade emotionally once these beliefs are internalized, primarily due to principle 3. I completely accept the risk. You take 100% responsibility for all results, all profits, all the losses, all the actions, all the inactions, everything. If you hold the 5 beliefs, you can follow the 7 principles because the beliefs support the principles. If you follow the principles, especially item 7, then you do not need to learn emotional control because you are already living out the beliefs that manifest calm and effortless control of emotions. This makes perfect sense if you buy the idea that behavior comes from values and values come from beliefs. Beliefs underlie all your values, and values underlie all your behaviors. Therefore, work on beliefs and not emotional control per se. If you hold the 5 beliefs, you are going to be very disciplined about risk. If you truly believe anything can happen at any time, you are going to put strict limits on the total risk you are willing to take. If you did not impose limits on risk, you clearly did not hold the belief that anything can happen. The 5 beliefs and 7 principles force a complete understanding of all risks and complete management of those risks, especially risk of ruin. The 5 beliefs and 7 principles manifest great respect for risk. To hold the 5 beliefs and follow the 7 principles, you must be ready, willing, and able to take 100% responsibility for all your results. This 100% acceptance of all responsibility means you are never a victim of anyone else, ever, and that all the credit, if any, belongs to you and you alone. What level of competence you actually achieve is in direct proportion to how fully and faithfully you adhere to these beliefs about trading. Regardless of how high the probability derived from one strategy may be for the success of a particular setup, the outcome of any given trade is unknowable. In other words, you do not have to know or even care whether a given trade is going to be successful. You know or should know from your strategy that over time, over a series of trades, a given percentage of them, plus or minus, are going to be successful. If the setup is not clearly defined, then none of this applies, and the probability of success for any given trade is pretty much left to chance. Finally, it's important to rid oneself of the notion that the market is out to trick them. Those who believe this will never be able to trust their perceptions, much less whatever actions they take or are thinking about taking based on them. The market is not out to trick you. It does not even know you, much less care about you. Those who believe that the market is out to trick them have an exaggerated sense of self-importance, exacerbated by the fact that they do not know how to interpret what is going on in front of them.